Hello.
and Kathryn Rooney Vera, who is the Chief Market Strategist for StoneX Financial. Hi, Kathryn.
Hello, good morning.
Thank you both. Now, just very quickly to what's expected, the consensus view from economists is that we take another small step in the right direction here. Economists predict that um, month on month headline inflation is going to have risen 0.2% in July from a year earlier. It's expected to have edged up a little bit from the previous reading, so 3.3% for July versus 3% in June. But really, the most significant number is core CPI, and that's the number that strips out volatile food and energy prices, crucially energy prices, in this stretch. And on the month, core CPI is predicted to have climbed 0.2%. Now, if you look at that on an annualized basis, it would be consistent with the Federal Reserve's 2% inflation target for a second straight month. And we've seen, a lot of buoyancy in the market. Sentiment has been good as people look across the data and think, maybe the Fed is done. Maybe we avoid a recession despite the incredibly harsh stretch of interest rate hikes we have seen in recent months. But I think we have a little bit of time just to go quickly. Maybe we'll start with you, Kathryn. What's the main thing that you want to see in these July numbers?
I'm looking at rent inflation as well as of course the energy price and the headline. We should see a deceleration in headline, of course, because the base effects are favorable, but that will be temporary. August is likely to see a reacceleration due to said base effects. But what I'm mostly closely looking at is core inflation, core goods. I do expect car prices to contribute favorably, meaning we've seen a decrease in pricing there, both on used and new car prices. Rents should also be something that contributes favorably. Now, this data print I think is widely expected to see a deceleration in headline. I'm expecting 3.3% year on year, just like consensus from Bloomberg. Core inflation, I have my forecast models show exactly the same as consensus, 4.7% on core. So we do see a slight acceleration in core. My concern is not this month; it's going to be after in a few months' time when we get the disinflationary trend. If it continues or if we get a reacceleration in inflation.
That's a really good point, Kathryn, and something that Alice and I have discussed that the Fed has done a great job so far, but its job isn't done. And Alison, if I can just bring you in for what you think are the main challenges that they face going forward.
Well, I think they're going to have to see how entrenched inflation expectations really are. I mean, if you look at market-based expectations, they've been pretty stable, honestly, even when inflation was super high. But I think the concern is that inflation expectations do become entrenched. People do get used to higher inflation, or are just now concerned that inflation is a risk that they didn't worry about, and it's baked into risk premiums. Then inflation can become self-fulfilling, which is why I think it's also, I'm also looking at rents, because rents are a good indicator of what people think inflation is going to be the whole year going forward. So it's also a nice indicator of expectations. So I think, the expectations is also largely how the Fed operates now through their policy, through their communication. So I think that's going to say a lot about what they're going to do going forward as well.
Okay, you make some good points there. Only 30 seconds to go, but I think enough time to probably say that one of the things that seems to have, gotten people a little bit worried in the recent data set was the strong wage growth numbers that we saw last week. I think people have begun to question whether, with a strong labor market, wage growth numbers that's going as well as it is right now, can the Fed really continue to tame inflation? Former Treasury Secretary Larry Summers said on Bloomberg television that he's actually worried about an acceleration. I see that we have the numbers coming down now. Let's see where we are. US July consumer prices increase 0.2 month on month. That's bang on the estimate. Core consumer prices rise 0.2 month on month. Again, in line with consensus. And that seems to be the theme pretty much. July core consumer prices for the year are up 4.7%, again in line with estimate. And the only one that's a little bit off, I think, is the headline consumer price number for the year-on-year number, which is 3.2 versus an estimate of 3.3. So the monthly numbers certainly are well in line with expectations, and stock futures, unsurprisingly perhaps, are climbing already at their session highs. I guess that's sort of, to be expected, Kathryn. People are going to look at this and say, that's it, job done, continue with business.
Certainly. Well, like you said, Candice, a headline CPI came slightly below expectations year on year, but expect that to be temporary. The month of August is probably going to move higher and potentially sharply, because we did see a reacceleration in energy prices. So this might be a temporary thing with regard to headline inflation. I think the core is what's really important here, and we probably will see a continued disinflationary trend there. But remember, 4.7 or core PCE 4.1, that's still far off from the 2% target. So I think we can probably, most of us agree that the difficult part has been getting headline from 9 to 3.
9, yeah.
But the long haul and the heavy lift is going to be getting core from double the target to target in a service-based economy, with inflation being overwhelmingly driven by increases in service cost, in an economy that, as we've talked about on Bloomberg many times, unemployment at near record lows, positive real wages, and trending higher, and consumer confidence resilient and robust. The tough part is going to be getting from 4 to 2 on the core front.
So Kathryn, I'm going to put you on the spot here a little bit. Do you then think that the Fed continues tightening, or are we done for the year?
We're done for the year. My forecast models show that we get core PCE finishing the year at 3.8, maybe even lower. And that's consistent with the Fed's own forecast. Of course, it's not consistent with the 2% target, but it's consistent with the Fed's forecast. So I do strongly believe the Fed is probably going to remain on hold. This disinflationary trend is what has moved the markets higher, and that's why we're all talking about CPI today. It's taken over from non-farm for being the most watched data point, and with reason, right? So as we get inflation showing a slower trend, that means the Fed can halt its rate hikes, and it probably will. My concern, Candice, is going forward, if we get that reacceleration of inflation, or it remains sticky, right? If it ends the year at 3.8%, remains sticky around 4%, then I think we're talking about a Fed that's not cutting next year, and the markets have discounted at least 100 basis points of cuts for 2024.
Wow, that's a lot. That's a lot of disappointment if
Right.
things don't turn out as people expect. Allison, what do you think? Are we done, or does the Fed have to kind of, not reverse track, but certainly disappoint the market?
I think that there's a good reason to expect the market's going to be disappointed. I mean, as I said, we've said before that, this last 2% is the hardest. To some degree, there was a big component of inflation that was legitimately transitory, that was very pandemic related. I think most of those factors are now gone. We still see very high inflation in the services sector, which shows that inflation is somewhat entrenched, and particularly is in wages. And so getting rid of that's going to be harder. And I think from the Fed's perspective, what they've been doing so far hasn't had a big impact on the labor market. So, why not do another increase? I mean, maybe not this year, but I think if inflation, as Kathryn says, is still hovering around 4% at the end of this year, and unemployment still below 4%, I think there definitely could be cut. So it could be another increase. I don't see cuts happening in any time soon, unless there actually is a recession. I mean, I think when we want to when you want to think about like this could be sort of a normal policy rate for the time going forward, particularly if inflation does end up about 2.5%. In real terms, and the policy rate still isn't really that high. It might not be too off neutral. So I mean, even if there's no like reason to think that the Fed's going to cut a lot to bring us back to neutral. I'd only see them cutting if there's really a recession.
You raised this question of neutral and what is neutral. I was reading a column that former Fed policymaker Bill Dudley did for us recently, pointing to the persistent tightness in the labor market and what that means for Fed policy. And I think he made the case now that are we at a point where the neutral level of interest rates is perhaps higher? And if we are at that point for a variety of reasons, you could look at some of the, Biden policies and infrastructure, semiconductor and climate change initiatives. You could look at large fiscal deficits, but are we at a point now where the neutral rate is in fact a little bit higher and therefore the restrictive rate has to be a little bit higher?
Yeah, I think there's definitely reason to think that. I mean, no one ever really knows what the neutral weight is. It's sort of like calling it's more really of an art than a science. It's sort of this nebulous thing no one knows. So just in case people don't know, the Fed has three speeds. They're accelerating the economy, they're contracting the economy, or they're just doing nothing. So, or they're not doing either. So when the policy rate's at neutral, they're in that stance. So right now they're trying to tamp down, so it should be above neutral. If they're in a recession, they go below. So, but where is neutral? No one really knows. People were saying it was around 0% pre-pandemic, but as you said, all these structural issues with the Biden administration, just sort of a deceleration on globalization means there's less demand for US assets that also could increase. I've also personally, people have always said that an aging population lowers the neutral rate, but I've never really thought that made a lot of sense. I've always kind of thought that wasn't true. Now people are sort of second guessing that too. So it could just be that, maybe when the Fed feels it's done, it would cut maybe a little bit. I don't think it's going to cut as much as markets expect.
Okay. So I think we've discussed a lot about sort of the risk of disappointment here, given where the market is. And Kathryn, I want to just come back to you and talk a little bit about the uncertainty that sort of apparent and persistent. Do you think the market is a little bit too sanguine in what they're pricing in right now and their expectations for a soft landing scenario?
Yes, Candice, and just to add to what Allison mentioned, really good points, is that by my analysis, real wages, they have to come down. Not hugely, if you believe the BLS numbers. If you believe the Atlanta Fed numbers around 5.5% to 6% wage growth, they would have to come down markedly. By my estimates, it's between 3 and 3.5% real wage growth. That's more consistent with a 2% target. Of course, that's on average. So we would have to get wage growth even below that to average the 3.5% from way above that, which is where we are currently. So certainly, I agree that. We can look at R-star, we can debate it and estimate it, but as Allison correctly mentioned, it's very hard to define with precision either NAIRU or R-star, but that doesn't preclude us from making the attempt, right? So, I mean, if you look at the Taylor rule, it says the Fed actually has to be a little bit higher in terms of its Fed funds rate to get inflation back to the 2% target. So I do think that if the Fed is going to have some very tough choices, one specifically for 2024, if I'm right and if the market's right and we're not in recession and we're not on the cusp of recession, why? Because the labor market is so remarkably robust, because consumption is strong. Even the Fed, the Atlanta Fed nowcast estimates 3Q GDP here in the US of 4.1%, Candice, 4.1. When potential growth, I estimate at 2.2. So that's almost double, right? That's double potential growth rates. So my point here is, if the Fed has to make a tough choice next year, are they committed? Is it a strict interpretation of their dual mandate, or do they change the mandate, or do they give it flex? Right? I mean, they could effectively give it flex. They said the 2% target is an average. So that could be changed. 2% is arbitrary. It could be 2.5, 3. So the tough choice next year is going to be, accept persistently above target inflation to keep the party going, or take a strict interpretation of their dual mandate, which is stable inflation of an average of 2% with full employment, which we already have. So the part that's lacking is inflation, and break something here in the US economy to get to said target. And what would need to be broken, unfortunately, is consumption. The way to break consumption, and the consumption specifically of services in an overwhelmingly service-based economy, is by getting unemployment higher, unfortunately. Because if you have a job, if your wages are beating inflation and they're consistently rising, and that's the data that we're seeing, your habits of consumption do not change. And the trend right now is positive. So I don't see how the Fed gets to 2% in the current environment of robust consumption, consumer confidence booming, and a very strong labor market.
Right. And, just coming back to the question I tagged on there, what does that mean for markets then? Are they too optimistic and a little bit too kind of
Right, Candice.
believing in the soft landing scenario?
Thank you for bringing me back to your question. You're dead on for doing that. I got a little bit off on a tangent. But yeah, so what I'm telling our clients at StoneX is it's really important to hedge your portfolios right now. And I put out a piece, my first piece at StoneX 2 weeks ago, and I said, let's look at counter-cyclical portfolio policy. This is something that governments should do, aren't doing, haven't done in a period of time, but let's do it for our portfolios. And counter-cyclical portfolio policy is intuitively hedging yourself in boom times for those down times. My sense is that the market has priced in the best possible scenario, and that could happen, but there's a very good chance it does not. So what makes sense? Last week I recommended buying volatility. So triple Qs, which is the tech sector. And we all know that the breadth of this market rally has been not exclusive, but majority pinned to AI-driven tech. Yes? So we've seen triple Qs run up 45%. Vol is very, very low. So I recommended buying put options or put spreads. And that makes sense to me. And so far, the trade is profitable, because since in the past week, we've seen tech fall off a bit. So I think that makes sense. I think gold makes sense. I think cash at 5.5% on T-bills makes sense. I think starting to position yourself in those underperforming sectors of the S&P that historically outperform in down cycles makes sense. They're cheap now. Well, relatively speaking, versus other sectors, because the S&P has rallied so much. One other trade that I like and that I've been talking to clients about is I've highlighted the tips trades. So you can see real short dated tips, break evens, maybe underpricing the risk of inflation, and not to go too long, Candice, but I think this encapsulates maybe the complacency of the market with regard to the capacity of the Fed to get to the 2% target, which is the break evens could be underpricing the risk of inflation remaining elevated. January 2025 tips yields 3%. January 2025 nominals yield 5%. Implied inflation is 2%. So if we get sticky 4% inflation, then you're talking about tips giving you around a 7% yield. That's 3% real plus the 4% inflation. So I think that also makes sense. So there's opportunities both in equities, in commodities, as well as in the fixed income space, to position one's portfolio for what I think we should all consider, at least, to be part of the economic cycle. And the next phase of the economic cycle should in fact be some deceleration. Not right now, because the labor market remains very strong. But I think that's something to consider in the portfolios at this juncture.
Yeah, no, you make a good point, right? There's so much disinflation sort of baked into the next few months that I think investors run the risk of being blindsided a little bit, and then waking up and realizing that no, in fact, we're in an incredibly strong economic cycle. You pointed to the GDP Now forecasts, which are showing a sort of red hot US economy. And so then what does that mean as we get past the next few months? And we're also seeing, energy prices, on the other hand, starting to rise. We've seen 6 straight weeks of energy prices rising. Food inflation is starting to pick up again. So a lot of concerns on the margins there, I think, that people should be wary of, even as we concede that, we're in a good place today in that we're not seeing 9% headline CPI. Allison, I wanted to come back with you to this wage question, because there's been, I think, a little bit of back and forth, right? Break the back of the US consumer, and the only way to do that is via the jobs market. Mohammed El-Arian, who's another one of our Bloomberg contributors, said an interesting thing the other day when people were discussing wage growth numbers. And he said, well, I feel like the US economy can accommodate 4% wage growth. What do you think? Can we do that and continue to see inflation that is below or within the Fed's target?
Well, I mean, I think his point was if we had productivity that matched 4%, but I don't see that happening anytime soon. I mean, maybe in the next 15 years with AI, but like in the next 5.
AI will save us all, or
Yeah,
maybe unemploy us all.
I think we're counting on it. Definitely we quibble with how productivity is measured and if tech is really measured properly, but I don't think we can say, oh, we can get to a 4% wage growth where productivity is, particularly how we're structuring the economy lately. I mean, the Biden administration has been pretty transparent that they're willing to go with lower growth if we have more equity in the economy. So, I mean, that's not consistent with a high productivity economy. That's a slower growing but more equitable economy. And I mean, people can debate what they think is more important, but it also suggests that we're not going to have 4% real wage growth without high inflation. So, I think maybe, it's hard because on the one hand, it's really great that particularly people on the lower end of the income spectrum are getting real wage gains they haven't had in years, or they were just starting to get pre-pandemic. And considering the years of wage stagnation, particularly for middle and low income people, that's wonderful. But on the other hand, I think we're also seeing that comes with a cost, which means everyone's poorer in real terms too, overall over the last couple of years. So I think Kathryn makes a good point, and I worry long term what that means, that the Fed might just really give up on their target. You could argue they already did even before the pandemic when they decided they couldn't reach the target because inflation was too low, and then they started talking about average targeting. So I think they might lose a big hit to their credibility long term around this target, and I think there are costs to that too. I think a problem we have that Kathryn's pointing out is we have a generation of investors who have no concept of inflation, have no concept of what that behavior means, that inflation tends to go down and then it goes up. And this is like a years-long process. And then even what high interest rates mean. I mean, and sort of what that means for the labor market and what that means for investing. So I think we're in a space a lot of people probably actually all of us look young enough, really have never been before, but we can read history and be nervous.
Can I jump in, Candice? Because I just agree very much with Allison. Probably that's not the best combo for a panel, but I just I can't help but nod my head whenever she's talking. And I'll just add to her point, which is generationally, and we have to consider this in behavioral economics. I have this chart which shows over the past 4 decades. So that's anybody who's alive right now in the markets. We the majority of our lifetimes, the majority of the past several decades, we've lived in the second quadrant of economic cycle, which is Goldilocks. That's low inflation and high growth. We are conditioned, we are predisposed to believe that that's mean reversion, right? Like that's where we live. So recessions are kind of outside of our purview. We've lived mostly in low inflation and high growth. So important to consider. The other point that I wanted to add to hers was, over the past 6 quarters, productivity has been negative in 3 of those. So half of the past 6 quarters, productivity has been negative. We just got a very great flip. I'm very happy to see, second quarter growth, productivity came out positive, fantastic. But that's one data. I mean, we need to trend for productivity to offset inflation in a considerable and consistent, meaningful way. We need to get productivity up. And it has to be sustainably positive, right? Because when you look at the past 3 quarters of the past 6, what we've seen is productivity dropping and unit labor costs increasing. That's a horrible, horrible combination. And when I would see that, I would say, in what realm of reality do companies not shed employees, right? If you're getting less and paying more, it makes no sense. But this has been interesting. And I think that the market participants who consider the after effects of this massive pandemic, massive fiscal stimulus, inordinate monetary policy, and consider it a structural change, I would differ with them. I think that this legacy of liquidity and the longevity therein has surprised all of us, but that doesn't mean that it lasts forever. So we need to be careful, I think, of this anchor bias. Where we are today is not where we will forever be. And that's why I'm more cautious than I would say consensus. And that's why I'm recommending clients to be wary of the headlines and start to just, I mean, you don't have to liquidate your equities, but at least let's start protecting them, right? So remain overweight, that's fine, but start protecting yourself. And, you know, I kind of like, it's akin to a squirrel stashing acorns away. You know, those are the ultimate risk managers. They're, you know, they're like us. When things are looking good, they're flying from tree to tree, no problems, no questions asked. But they also are stashing away. And I think we can both play the markets, be a part of it, maintain our overweight in equities, but start to accumulate fixed income, which historically outperforms in down cycles going into 2024.
Thank you for that. I wonder if we have just a couple of minutes for one last question, because you both brought up a really interesting thing around expectations. You know, what are our expectations of inflation given where we've come from the last 10, 15 years? We're beginning to see sort of energy prices really kick up again. Do you think we're at any risk that inflation expectations come unanchored as consumers, you know, time and time again encounter what they really haven't for a long time, which is higher food prices when they go grocery shopping and higher fuel prices when they go to tank up?
Yeah, I mean, I think to a large degree, the innocence is already lost. I mean, people have already gone to the market and seen eggs for $7. And so, I mean, Sid, we had a generation of people who it was unthinkable you'd ever go to a grocery store and not know what things would cost. And now that's true. So I think to some degree, inflation came down pretty easily because people just expected it to. And now if it goes up again, it's going to be a very different feeling. And I think we're already, weirdly, anyway, inflation, we're seeing this disinflation starting to see even expectations creep up. Or one of my favorite indicators is the New York Fed's uncertainty around inflation. And that is actually as elevated as it's been since the last 2 years. That has not come down a lot. Yeah. So, or the distribution around expectations is much higher. So I said, I think we're seeing already that innocence lost around inflation that I don't think anyone's getting back.
And I'll add to that, that if the Fed does change their target or cut before reaching said target, then that puts at risk inflation expectations going forward. It puts at risk policy credibility. And if we are in an exclusively data-dependent Fed, that brings inherent volatility. So if the Fed is effectively every month looking at the data and could change on a dime, then I think that causes uncertainty, as Allison said, with regard to both monetary policy and the inflation trajectory. So I would be wary of inflation expectations. For now, they're anchored. You know, if you look at 5s, 10, 30-year break-even inflation, they're pretty well anchored. So what the market has priced in is lack of policy error, and that's great. Maybe you know, this is a smooth landing. Maybe it's smooth sailing and blue skies from here on out. But history says, you know, things can happen. So I'm more cautious than I think consensus is. I think there is always room for error, and I would be protecting downside at current levels.
Well, I think we can end there. You know, good news for the time being, but stay vigilant, stay cautious, protect yourself. And, you know, this, as you said, I think, Kathryn, is going to be the most important number, one of the most important numbers to be looking at in the months ahead, as we gauge just how high our mortgage rates, if nothing else, are going to go. So thank you both so much for joining me today.
Thank you.
Thank you.